I need you to stop everything you're doing right now. Close the other browser tabs, put your phone on silent, turn off the notifications, because what I'm about to share with you is not just another market update. It is not just another piece of financial news that you can scroll past and forget about by tomorrow morning. What happened in the silver market over the last 72 hours is a structural break. It is the kind of event that separates those who saw it coming from those who will spend the rest of their financial lives wondering how they missed the most obvious signal in modern commodity history. Silver just broke $80 per ounce for the first time ever. Not the first time this year, not the first time this decade, the first time in the entire history of silver trading on modern exchanges. $80, that number is now printed on the charts forever. And if you think that number is just a round psychological level, if you think it is just a temporary spike that will correct back to normal, you are fundamentally misunderstanding what is happening in this market right now. Because immediately after silver touched that historic $80 level, something extraordinary happened. Something that the mainstream financial media is calling a correction, but which is actually far more significant. The price pulled back. It retreated from that peak. And in China, the epicenter of global silver demand, the only pure play silver investment fund in the entire country, crashed by 10% in a single trading session. The 10% was not just a bad day. It was the maximum allowable daily decline. The circuit breaker triggered. The exchange literally stopped the bleeding because the selling pressure was so intense that they could not allow it to continue. And here's the part that should make every single person watching this video sit up straight in their chair. The fund manager, the person who runs this investment vehicle, the professional whose entire career depends on attracting capital into silver, issued a public warning to investors. They said the gains were unsustainable. They told their own customers to be cautious. They capped new subscriptions. They changed the rules of the game in the middle of the game. When the person selling you the product tells you the product is overheated, you need to pay very close attention, not because they are right about the direction. They may be completely wrong about where silver goes next, but because their warning tells you something critical about the positioning of the market. It tells you that the institutions are scared. It tells you that the paper structure is under stress. It tells you that the gap between what people are willing to pay and what the underlying asset is actually worth has stretched to a point where even the professionals cannot pretend it is normal anymore. Let me walk you through exactly what happened in China, because this is where the fractures are most visible. This is where the stress in the global silver market is manifesting in real time. And this is where you can see the future of silver pricing before it arrives in New York or London. The UBS SDIC Silver Futures Fund LOF is China's only dedicated silver investment vehicle. If you are a Chinese investor and you want exposure to silver without physically buying bars and storing them in your apartment, this fund is essentially your only option. That monopoly position means that when Chinese investors get excited about silver, all of that enthusiasm flows into a single vehicle. And over the past several weeks, that enthusiasm has been off the charts. The fund gained 220% in a single year. Let me make sure you understand what that number means. If you invested $10,000 Gwen at the beginning of the year, you now have $32,000 when your money more than tripled in 12 months in a single asset. That is not a normal return. That is not even an exceptional return. That is a generational return. That is the kind of performance that builds fortunes and creates legends. But here is where the math starts to break. While the fund was gaining 220%, the underlying Shanghai silver futures were only gaining 128%. Still an incredible performance, still a historic year, but a 92% gap between the fund performance and the underlying asset performance. Where is that extra 92% coming from? It is coming from the premium. It is coming from the price that investors are willing to pay above the actual value of the silver because they are so desperate to get exposure. At the beginning of the month, the premium over the underlying asset was 7%. That is elevated, but within the range of normal market dynamics. By Wednesday, that premium had exploded to 62%. 62%. Investors were paying a 1.62 for every dollar of actual silver value in the fund. They were paying a 62-cent tax on every dollar just for the privilege of owning paper that represents metal they will never touch. In any rational market, this premium would be arbitraged away within hours. Sophisticated traders would short the overpriced fund and buy the underlying futures, capturing the spread as risk-free profit. The premium would compress back towards zero as the arbitrageurs did their work. But the arbitrage is not happening. The premium is not compressing. It is widening day after day after day. And the reason the arbitrage is failing is the same reason that premiums are exploding around the world. There is not enough physical silver to execute the trade. The paper market has become disconnected from the metal market. The price on the screen no longer represents the price you would pay to actually hold an ounce of silver in your hand. Those are now two completely different numbers, and the gap between them is growing. UBS SDIC Fund Management responded to this crisis by changing the rules. Starting in December, they are capping new Class C share subscriptions. These are the shares that short-term investors prefer because of their fee structure. The cap is dropping from 500 when to somewhere between 26 and 100 when that is a reduction of 80 to 95%. They are essentially telling short-term speculators that they are no longer welcome. They are trying to slow the inflows because they cannot handle the demand. Think about what this means from the fund manager's perspective. Their entire business model is based on attracting assets under management. The more money that flows into the fund, the more fees they collect. Turning away new investors is like a restaurant turning away hungry customers during dinner rush. You only do it if the kitchen is on fire. You only do it if you physically cannot serve the demand. The fund manager is telling you that their kitchen is on fire. They are telling you that the supply chain that connects paper silver to physical silver is broken. Now, let me address what the critics and the skeptics are going to say, because I can already hear the comment section filling up with objections. They are going to say this is a bubble. They are going to point to the 10% crash as evidence that the top is in. They're going to say that the fund manager's warning proves that smart money is getting out. They're going to tell you that if you buy silver here, you are the bag holder at the end of the musical chairs. And to those critics, I say you are looking at the surface and missing the substance. Yes, the fund crashed 10%. But what happened the 3 days before that crash? The fund hit its 10% upward daily limit 3 days in a row. The price was ripping so hard that the exchange had to stop trading because it could not go any higher. The 10% crash on the fourth day was not a bubble popping. It was a consolidation after 3 days of maximum possible gains. The net result of those 4 days is still massively positive. Yes, the fund manager issued warnings, but fund managers issue warnings for legal protection, not clear's throat, because they have a crystal ball about price direction. They issue warnings so that when investors lose money, those investors cannot sue and claim they were not told about the risks. The warning is a legal document. It is not a trading signal. Yes, the 62% premium looks insane, and it is insane in the context of normal market functioning, but we are not in a normal market. We are in a market where the largest producer and consumer of refined silver, China, has implemented export restrictions that went into effect on January 1st. We are in a market where industrial demand from solar panels, electric vehicles, and artificial intelligence data centers is consuming every available ounce of supply. We are in a market where inventories have fallen to their lowest level in recorded history. The premium is not a sign of irrational exuberance. The premium is the market telling you the truth. It is telling you that the spot price, the number on your trading screen, is a lie. It is telling you that if you want to actually acquire physical silver, you have to pay far more than the official price suggests. The premium is the real price trying to break through the artificial ceiling of the paper market. Let me give you the industrial demand numbers, because this is where the fundamental case becomes undeniable. Solar panel manufacturing consumes approximately 170 million ounces of silver per year. That number is growing by double digits annually as the world races to install renewable energy capacity. Every solar panel requires silver paste to form the electrical contacts that capture the photovoltaic energy. There is no substitute at scale. The solar industry has tried alternatives. They have tried copper. They have tried aluminum. Nothing works as well as silver. Nothing has the same conductivity, the same durability, the same resistance to corrosion. If you want to build solar panels that work efficiently for 25 years, you need silver. Period. Electric vehicles are adding another layer of demand. Every electric vehicle contains more silver than a traditional internal combustion engine car. The battery management systems, the charging contacts, the electrical distribution systems, the motors, all of these components require silver for their electrical connections, because silver is the most conductive element on the periodic table. As the global vehicle fleet transitions from gasoline to electric, silver demand from the automotive sector is growing by 30 to 40 million ounces per year. Artificial intelligence is the new wild card. Every AI data center requires massive quantities of silver for the servers, the cooling systems, the electrical infrastructure. The chips that power AI applications use silver in their packaging and interconnects. The thermal management systems that prevent those chips from overheating use silver because it is also the most thermally conductive element. As AI demand explodes, as every major technology company races to build bigger and more powerful data centers, silver consumption is accelerating in ways that even the industry analysts did not predict 2 years ago. Consumer electronics continue their steady drumbeat of demand. Smartphones, laptops, televisions, medical devices. Every electronic gadget you can name contains silver. The quantities per device are small, but the volume of devices manufactured every year is staggering. Billions of units, each requiring a fraction of a gram of silver. Those fractions add up to hundreds of millions of ounces. Now add up all of these demand categories: solar, electric vehicles, artificial intelligence, consumer electronics, industrial applications, photography, jewelry, silverware investment. The total global demand for silver is approximately 1.2 billion ounces per year, and that number is growing. Now, look at the supply side. Global silver mine production is approximately 800 million ounces per year. Recycling adds another 150 to 180 million ounces. Total supply is somewhere around 950 million to 1 billion ounces. Do the math. 1.2 billion ounces of demand, 950 million ounces of supply. There's a structural deficit of 200 to 250 million ounces per year. That deficit has persisted for 5 consecutive years. The cumulative shortfall since 2021 exceeds 800 million ounces. Where has that 800 million ounces come from if it was not produced by mines and recyclers? It came from above ground inventories. It came from the vaults. It came from the stockpiles that were built up during the years when supply exceeded demand. And those stockpiles are now at their lowest level in history. The buffer is gone. The safety margin has been consumed. The silver market is running on fumes. This is not a cyclical imbalance that will correct itself next quarter. This is a structural deficit that requires either a massive increase in supply or a massive increase in price to destroy demand. The mines cannot increase supply. Silver is primarily produced as a byproduct of copper and gold mining. You cannot just drill more silver holes when the price goes up. You have to wait for new copper and gold projects to come online, and those projects take 10 to 15 years to develop. There is no supply cavalry riding over the hill to save the market. That leaves demand destruction as the only balancing mechanism. High demand destruction only happens at much higher prices. The solar industry will not stop using silver until the price forces them to invest billions in alternative technologies. The EV industry will not stop using silver until the price makes electric vehicles uneconomical. The electronics industry will not stop using silver until the price forces a complete redesign of circuit board technology. Those price levels are not 80. They are not 100. They might be $150 or $200 or higher. The market needs to ration the available supply, and the only rationing mechanism in a free market is price. Elon Musk weighed in on the situation over the weekend. When presented with information about China's export restrictions on strategic metals, including silver, his response was characteristically blunt. 2 words, not good. Now, you can dismiss that as a casual tweet from a billionaire who comments on everything, or you can recognize that Elon Musk runs companies that consume enormous quantities of silver. Tesla's electric vehicles, Tesla's energy storage systems, Tesla's solar roof products, the factories that build all of these products require reliable access to silver at predictable prices. When Musk says the situation is not good, he is speaking as an industrial consumer facing supply constraints. He is telling you that the boardrooms of major manufacturers are worried about their ability to source critical materials. The geopolitical backdrop is adding layers of complexity and risk. The United States has blockaded oil tankers connected to Venezuela. Washington has taken military action against targets in Nigeria related to the Islamic State. Every escalation in global tensions increases the appeal of precious metals as safe haven assets. When the world feels unstable, when currencies feel unreliable, when governments feel untrustworthy, investors historically turn to gold and silver. This is not a new phenomenon. It is a pattern that has repeated for thousands of years across every civilization. And right now, the world feels very unstable. Indeed. Central banks are responding to this instability by accumulating precious metals at the fastest pace in decades. China has been adding to its gold reserves consistently. Other central banks from Singapore to Poland to India have been diversifying away from dollar-denominated assets and into hard money. While most of this accumulation is focused on gold, the underlying philosophy applies equally to silver. Monetary authorities around the world are hedging their exposure to fiat currencies that can be printed without limit. The Federal Reserve has cut interest rates 3 times. Each rate cut makes non-yielding assets like silver more attractive relative to bonds and savings accounts. When you can earn 5% in a money market fund, holding silver that pays nothing feels like a sacrifice. When interest rates are falling toward 3% or 2% or 0, that sacrifice becomes much smaller. The opportunity cost of holding silver is declining, and as that opportunity cost declines, investment demand increases. The combination of these forces, the industrial demand surge, the inventory depletion, the geopolitical uncertainty, the central bank accumulation, the falling interest rates, has created a perfect storm for silver. The 2 to 20% gain in the Chinese fund is not an aberration. It is the leading edge of a global repricing event. China is simply seeing it first because Chinese investors have the most concentrated exposure through a single vehicle. Now, let me address the most important question. Is this a bubble that is about to pop? And the answer is more nuanced than either the bulls or the bears want to admit. Yes, the short-term price action shows signs of speculative excess. A 62% premium over underlying value is not sustainable. At some point, that premium will compress. Either the fund price will fall, or the underlying futures will rise, or some combination of both. Investors who bought at the absolute peak of the premium are likely to see paper losses in the short term. The fund manager is correct that the recent pace of gains cannot continue indefinitely. But no, this is not the end of the silver bull market. The fundamental drivers that pushed silver from $20 to $80 are still in place. The industrial demand is still growing. The supply deficit is still widening. The inventories are still falling. The central banks are still buying. The Federal Reserve is still cutting. None of these structural forces have reversed. The pullback from $80 is a consolidation, not a trend, clears throat reversal. The confusion arises because people conflate the paper market with the physical market. The Chinese fund can crash 10% and immediately rebound 8% the next day because it is trading paper. The premium can expand and contract wildly because it is a function of supply and demand for fund shares, not supply and demand for actual metal. This volatility tells you almost nothing about where the long-term price of silver is heading. It tells you everything about the stress in the paper structure. The physical market is a different beast entirely. Physical silver premiums from dealers around the world have been elevated for months. If you try to buy a silver bar or coin today, you will pay $90 or $95 or more depending on the product and the dealer. That premium overspot has been persistent. It is not compressed even as the spot price rose. This tells you that the physical market is even tighter than the futures price suggests. The real price of silver, the price at which you can actually acquire metal and hold it in your hand, is higher than any number on any exchange. Let me give you some context by looking at history. The last time silver experienced a rally of this magnitude was 1979 and 1980. That was the Hunt brothers era. Nelson Bunker Hunt and his brother William Herbert Hunt attempted to corner the silver market by accumulating massive quantities of physical metal and futures contracts. They drove the price from $6 to over $50 in a matter of months. The squeeze was spectacular, the crash was devastating, and the exchanges changed the rules, forcing liquidation only. The brothers were broken. Silver collapsed back to single digits and spent the next 20 years in a bear market. The bears will point to that history and warn that we are repeating the cycle. They will say that speculative excess always ends in tears. They will say that the higher silver climbs, the harder it will fall. But the comparison to 1980 misses a critical difference. The Hunt brothers were speculators trying to manipulate the market for profit. Today's demand is coming from industrial consumers who need silver to manufacture products. Samsung is not trying to corner the silver market. They're trying to make smartphones. Tesla is not trying to squeeze the shorts. They're trying to build electric vehicles. Apple is not playing financial games. They're trying to run data centers. Industrial demand is fundamentally different from speculative demand. Speculators can be shaken out with a 20% price correction. Industrial buyers cannot walk away from their supply chains. They have contractual obligations. They have production schedules. They have customers waiting for finished products. When an industrial buyer needs silver, they buy silver regardless of whether the technical chart looks overbought. This is why the current rally has staying power that the 1980 rally lacked. The foundation is industrial demand, not financial speculation. Yes, there are speculators in the market. There are always speculators. But they are riding a wave that is powered by real consumption, not creating a wave out of pure financial engineering. The other critical difference is the monetary environment. In 1980, the Federal Reserve under Paul Volcker was aggressively raising interest rates to crush inflation. Rates went to 20%. 20%. That made non-yielding assets like silver extremely unattractive. The opportunity cost of holding metal was enormous. Today, the Federal Reserve is cutting rates. They are moving in the opposite direction from Volcker. They are making it easier to hold precious metals by reducing the yield you sacrifice by not holding bonds. The fiscal situation is also dramatically different. In 1980, the U.S. national debt was less than $1 trillion. Today, it exceeds $34 trillion. The debt-to-GDP ratio has exploded. The government is running deficits that would have been unimaginable a generation ago. This debt overhang creates persistent pressure on the dollar and persistent demand for hard assets that cannot be printed. So where does silver go from here? Let me give you a framework for thinking about this that goes beyond the hyperbolic price targets you see on social media. In the short term, meaning the next few weeks to months, expect volatility. Significant volatility. The kind of volatility that shakes out weak hands and tests conviction. The move from $70 to $80 was too fast. Markets rarely move in straight lines. There will be pullbacks to the $70 or $65 level that make headlines about the silver bubble bursting. The 62% premium in the Chinese fund will compress, possibly violently. Traders using leverage will be stopped out. Options will expire worthless. The financial media will declare the silver story over. Do not be fooled by this noise. Short-term volatility is the tax you pay for long-term returns. Every bull market in history has experienced corrections of 20% or 30% along the way. Those corrections are features, not bugs. They are what allow the bull market to continue by resetting sentiment and clearing out the speculation. In the medium term, meaning the next 6 to 12 months, the structural deficit will continue to bite. Inventories will continue to fall. Industrial demand will continue to grow. At some point, the paper market will lose the ability to suppress the price through additional shorting, because there will not be enough registered metal to backstop the contracts. When that happens, the paper price will be forced to rise toward the physical price. The $10 and $15 premiums that dealers charge today will become the new baseline. The spot price will absorb those premiums. I expect silver to trade between $90 and $120 by the end of 2026. That is not a wild prediction. It is simply the arithmetic of supply and demand applied to a market in structural deficit. The price needs to rise to attract recycling supply and to ration industrial demand. $80 is not high enough to accomplish either of those goals. Higher prices are mathematically required. In the long term, meaning the next 3 to 5 years, the green energy transition will consume silver at a rate that overwhelms any conceivable supply response. The world has committed to installing hundreds of gigawatts of solar capacity every year. Every gigawatt requires roughly 20 million ounces of silver at current technology levels. The world has committed to transitioning the vehicle fleet to electric propulsion. Every million electric vehicles requires roughly 1 million additional ounces of silver. The AI boom is just beginning. Data center construction is accelerating, not slowing. Against this demand backdrop, there are no new major silver mines scheduled to come online. The projects that exist today are the projects that will supply the market for the next decade, and those projects are not large enough to close the deficit. The only way to balance this market is with dramatically higher prices that either destroy demand or unlock massive new supply. Both outcomes require silver to trade at levels that most people today consider impossible. Now, let me talk about what you should actually do with this information, because analysis without action is just entertainment. If you are holding paper silver positions, understand the risks you're taking. Paper claims on silver, whether futures contracts, ETF shares, or unallocated accounts, carry counterparty risk. The exchange can change the rules. The fund can halt redemptions. The bank can force cash settlement. You're playing in a casino where the house can flip the table if they start losing. The 10% crash in the Chinese fund is a preview of what paper silver can do in a single day. If you cannot handle that volatility, you should not be playing that game. If you are holding physical silver, congratulations. You own an asset that is trading at a significant discount to what industrial buyers are willing to pay in the global market. Your metal cannot be marginal called. Your metal cannot be halted. Your metal cannot be settled in cash against your will. You're outside the casino watching the chaos through the window. The short-term volatility in the paper market does not change the ounces in your safe. If you do not yet own silver and you're considering a position, understand that the window of opportunity is narrowing. The days of buying silver at $20 are gone. They are never coming back. The days of buying at $50 are gone. The days of buying at $70 may also be gone, depending on how the next few weeks unfold. Every ounce that drains from the inventories is an ounce that someone else owns and that you do not. The supply is finite. The demand is growing. The math does not require a finance degree to understand. Do not chase the premium. Do not pay 62% over the underlying value like some of the panicked investors in China. Wait for the inevitable pullbacks. Wait for the days when the headlines scream that silver is crashing. Those are the buying opportunities. The best time to buy is when everyone else is afraid. Do not use leverage. I repeat, do not use leverage. The volatility in this market will destroy leverage positions. The banks and the exchanges will conspire to run stops and force liquidations. They have the algorithms, the capital, and the rulemaking authority to crush speculators. The only way to win is to hold physical metal with no counterparty risk and wait for the structural forces to play out. Do not try to time the top. No one knows where the top is. Anyone who claims to know is lying. The market will go higher than the bulls expect at the peak and lower than the bears expect at the trough. Position yourself with a size you can hold through the volatility and then simply hold. The destination is determined by the structural deficit. The path is chaos. Here is what we know for certain. Silver broke $80 for the first time in history. China's only silver fund crashed 10% after gaining 220% in a year. The premium over underlying assets hit 62%. The fund manager issued warnings about unsustainable gains. Inventories are at their lowest level ever. Industrial demand is accelerating. Supply is stagnant. The Federal Reserve is cutting rates. Geopolitical tensions are rising. Elon Musk says the situation is not good. These are facts. They are not opinions. They are not predictions. They are documented realities that you can verify from public sources. The interpretation of these facts is where opinions diverge. The bears see a bubble that is about to pop. They see the fund crash and the manager warning as signs of an imminent reversal. They see the premiums as evidence of irrational speculation that will end in tears. The bulls see a structural repricing event that is just beginning. They see the fund crash as a healthy consolidation after 3 days of limit up trading. They see the premiums as evidence that the physical market is desperately short of metal. They see the warnings as legal protection, not trading signals. I've given you the data, I've given you the analysis, I've given you the historical context and the forward projections. Now you have to make your own decision about which interpretation you believe. No one can make that decision for you. No one should make that decision for you. What I can tell you is that the silver market has changed. The rules that governed the last 40 years of price suppression are breaking down. The paper mechanisms that allowed the banks to control the price are under stress. The physical reality of supply and demand is asserting itself over the financial engineering. This transition is messy, it is volatile, it is confusing, and it is far from over. The events of the last 72 hours are not the end of a story, they are the middle of a story. The opening chapters were written over the past few years as the deficit accumulated and the inventories drained. The middle chapters are being written right now as the premiums explode and the paper market shows stress. The final chapters will be written in the months and years ahead as the market finds a new equilibrium at prices that actually clear supply and demand. You are living through one of those rare moments when the fundamental structure of a major market is shifting. Most investors will not recognize this moment until it has passed. They will look back from 2028 or 2030 and wonder why they did not see what was obvious in hindsight. The numbers were there, the trends were clear, the conclusion was inescapable. The only question is whether you're paying attention now in real time while the opportunity still exists, or whether you are waiting for permission from the mainstream financial media to acknowledge what the market has already shown you. The silver market just sent a message. The $80 print was the headline. The 10% crash was the exclamation point. The 62% premium is the underlying truth.